Hey guys, Simon Bryson here, welcome to my channel, and today I want to talk about exactly long-term investing and also short-term and which one is best for your money in a non-biased way. I'm not here to judge you if you're like a day trader or like a short-term trader, whatever you want to be. The point is, I'm not here to judge you. We're going to talk about exactly tax benefits, risk management, and also potential long-term profits and predictability when it comes to long-term investing versus short-term investing, and which one is best, okay? Because everyone is talking about this right now. And by the way, if you're new here, subscribe to the channel and hit the bell so you're notified. I post every single day, and on top, I also destroy the like button. Now, the first thing we have to establish here is, Tommy, what exactly do you mean by long-term investing and also short-term? I'm not here to tell you, well, Warren Buffett says long-term is 10 years, 5 years and above, and then short-term is basically like day trading. The answer is no. I'm here to tell you the exact real definition according to the Internal Revenue Service Department, and that stands for AKA the IRS, because that's what we really care about, okay? The IRS and what define this stuff as, okay? So basically, long-term investing, according to the IRS, is whenever you buy security or an asset, for example, a property, a bond, a stock, basically some jewelry, whatever it is, okay? And you basically hold it for more than 1 year and 1 day. And that is basically called long-term investing. However, if you hold on to it for less than 1 year, well, in reality, that's called short-term investing. And there are pros and cons to what the IRS, the federal government, is actually going to give you from benefits, for example, tax benefits, risk management, and a whole bunch of different things, which we're going to break down in this video right here. But just to clarify, guys, usually when you ask an investor, what exactly do you mean by long-term investing? Usually what we say is like, hey, we're talking about 5 years to 10 years to 30 to 40 to 50 years, and that's what we really consider like long-term investment. But according to the IRS, it's just 1 year and 1 day, you're good to go. Less than that, then in reality, is short-term investing, and that's very, very simple to actually understand. So always remember this, okay? 1 year and beyond, long-term. 1 year or less, short-term. That's the entire idea. And now the first pro and con we're going to talk about is basically capital gains tax and what exactly it actually means for long-term and also short-term investors. Now tell me, what exactly is capital gains tax? Well, in reality, it's how much money you're going to pay whenever you buy an asset, for example, a stock, a bond, a property, or whatever you buy out there, or basically even jewelry, by the way, or even valuable metals, for example, like gold. The answer is all this stuff is considered under capital gains, short-term and also long-term. But the idea is, okay, whatever profit you actually make from that investment, that is going to be considered capital gains. And the way you get taxed on that is going to be very different if, for example, you're a long-term investor or basically a short-term investor. And by the way, a very popular question I get all the time is basically, tell me, well, what if I buy like Tesla or maybe Google for like $1,000 and then I make, for example, $200? Do I get taxed on the whole 1,200? The answer is no. You only get taxed on the profits you actually made. In this case, it would only be $200. But in the future, that could be a ton more money. And that's why it's so important to understand exactly, well, what type of capital gains tax do I fall under as a short-term or basically a long-term investor? So here are the details so you can save a ton of money when it comes to taxes. And the first thing is this, guys. If you bought an asset, for example, a stock, and you sold it, for example, in less than a year, and you actually made some money, again, that's considered short-term, and you will get taxed as short-term capital gains tax. Now tell me, what exactly does this mean for me and also for my money and also for my profits? Because again, I want to keep as much money as possible. Well, in reality, here is what it means, okay? Whatever money you made in profits, if it's short-term investing, in reality, it will get taxed as ordinary income. And right now, what that means is basically that whatever money you make, for example, in income, they're going to grab that profit, put it in there, and basically tax you as if it was normal money, ordinary income, and that's the entire idea. But in reality, it can be very expensive depending on how much money you actually make. Because, for example, if you make between $40,000 to $85,000, you will get taxed around 22%, as you can see right here. But if, for example, if you make even more money, maybe more than $200,000, you will get taxed around 35% on the money you actually made. And to be honest, that is a ton of money, and that's why short-term investing, short-term capital gains tax is so difficult and also expensive. And that's why when you see like house flippers, in reality, they always have to take into account, hey, how much money are we going to pay in taxes when we go ahead and flip this house right here in less than a year? Again, it is very expensive dependent on how much money you actually make. And the only way to actually get away with paying like no tax, basically, if you make less than 10K, and then that way you basically get like no tax in reality. But again, who the heck is going to want to make 10K or less to then save money and taxes? In reality, most of us will not want that. If you have, for example, the average job out there, you get paid around $40,000 every single year. And again, you will be taxed around 22% on your capital gains tax if it's actually short-term capital gains, okay? So keep that in mind. But however, as a long-term investor, it is a little bit more different, and it also saves you a lot more money. And here's why, okay? Because basically, long-term capital gains tax is either taxed, for example, at 0%, 15%, or basically 20%, and that is about it. And when I was in college, I basically paid like around 0 to 15% every single time. By the way, I'm saying 15%, not 50%, 15%, okay? That's what I'm saying here. So for example, if you just bought a bunch of Apple stock, right? And you sold it, and basically you made maybe like $500 or $1,000, and you're like, okay, I have all this money, and I also held it for more than 1 year, long term. Again, you will be taxed with long-term capital gains tax, and basically means that, hey, if you make an income every single year less than $40,000, in reality, they will tax you at 0%. Isn't that awesome? And in reality, if you make more than $40,000 but less than $441,000, you will be taxed at 15%. And if you make more than that, they'll tax you at 20%. But obviously, you can tell here that basically, just by using long-term capital gains tax, you will save a ton of money in taxes, because basically, if you get taxed with ordinary tax, that's a lot higher than long-term capital gains tax. And that's why I always advise, okay, if you want to be a long-term investor, this is one of the best things to do, because basically you get to save a ton of money on taxes and keep a lot more of your profits. And that's the idea, guys. And by the way, if you're actually between like 18 to 22, you're probably not making like at least like more than like 40K every single year. So in reality, you'll be paying around 0% of all the money you actually make. But in reality, when you talk about long-term investing, I'm just holding and holding for the next like 30 to 40 years. But always, it is an option to actually make some extra money and sell the investment, but also pay no money when it comes to taxes. So that's a pretty cool legal way to kind of save money on taxes, if you ask me. Now, if you want to know why the government actually gives us tax break, the answer is because it gives the economy more stability, because basically means that people are holding on for a longer time. And on top of that, with the entire financial climate, usually is always the best idea to actually have people hold on for investments for a lot longer time, and that way they're not selling and losing a ton of money, and before you know, we have an entire problem with the entire economy. So it has a lot to do with the economy and the benefits, and that's why the government actually offers this tax break in a sense, or tax incentive in a sense, okay? And now the second pro and con I want to talk about is basically predicting the market and also making a decent return on your money, on your investments. Now, whenever someone invests for the short term, usually what they want is to basically make a lot of money in a short period of time, maybe double their money overnight. And although Warren Buffett says, for example, and the stats also say, for example, hey, that's very unlikely to actually happen, people still go ahead and try to do it, kind of like winning the lottery ticket, but in reality, the odds are always against you. But the whole point is this, guys, okay? It's usually 10 times more easier to predict what the market is going to do, for example, in 20 to 30 to 50 years than it is to predict what it's going to do tomorrow or this year or the next year after that, okay? So the long-term predictions are usually a lot more accurate, because we know, for example, that the economy is going to keep growing, your investors are going to keep growing, and step by step, everything is going to be fine. And for example, if you take a look at the S&P 500, the top 500 largest companies in the US, in reality, you would notice that basically in the past 50 years, the average return has been around 8% since 1957 to 2018. By the way, that is super long term. 50 years is a very long time, but the average return has been around 8%. But if you said, well, I want to predict what it's going to do this year and next year, the answer is you're probably not going to guess correctly, because you don't really know exactly what's going to happen in the short term. For example, say for example, you thought that, hey, in 2008, the economy was done, okay? The market actually crashed, but if you had invested then, in reality, in 4 years, it would have recovered and everything would have been back to normal. Also, in 2020, it crashed again because of the pandemic, right? But then 2 to 3 months later, it went right back to normal, okay? So the idea is, in the short term, you never know what is going to happen, honestly. But when you talk about the long term, usually the economy is going to keep growing, and also the average return is around 8% according to the stats and the figures that we actually have from the past, okay? So it's a lot easier to predict basically, hey, how much money am I gonna make in 50 years than it is to predict, like, hey, how much money am I gonna make tomorrow if I invest this much money? Can I actually double it? The answer is, it's like gambling. It's kind of like playing the lottery. So although you do have a chance, the odds are all against you. So long-term investing is usually a better option. Imagine, for example, if you actually sold in 2008 and basically locked your money, and also sold in March of 2020, the answer is no. Just holding on is always probably a better strategy if you do have a good portfolio, for example, into index funds. But on the other hand, guys, I also want to mention exactly how much money short-term investors like day traders actually make, because it's only fair to actually talk about that also. Now, the idea is, by a video done by Graham Stephan, he spoke about basically how the 80% of day traders actually lose money, around 36.3% every single year. And on top of that, the people that actually make money by day trading, they make like a normal salary of around $70,000 and below usually. And the people that actually make a ton of money, in reality, those people are just selling courses and also trying to diversify the way they make money, okay? So it's kind of like playing a game where all the odds are stacked against you. 80% of people losing money, and the people that actually make money don't make that much. And then the people that actually make money just want to teach you how to make money so they can make money themselves, okay? The answer is a very complicated issue with day trading, and I highly recommend it because basically is way too risky. And on top of that, all the money made by day trading, by holding on for like one day or like a week or whatever it is, the answer is, again, it is short term. So you will be taxed ordinary income, and you will be taxed a lot more than what you would have if you actually had a long-term capital gains tax, okay? And that's the idea here, okay? So when you talk about predicting the market and also how much money you'll make, the answer is long-term perspective is always a better idea. Short-term, we don't know what the market is actually going to do. You can't really predict that whatsoever. And the last thing I want to mention, guys, here is basically dollar cost average. And the answer is, it's something you can do when you're actually doing long-term investing. Say, for example, you have $10,000 right now and you want to invest it, but you're scared because basically, what if the market drops and have to wait a long time to have it recover and go back to normal, right? Because we know it'll go back to normal. Well, the answer is, instead of investing all that money all at once and taking that risk, the perfect strategy is to basically grab that money and invest it over a period of time, maybe like 1 year, and that way you get the average return for that entire year and don't have to worry about, hey, the market just dropped or whatever it is. For example, if you have 10K, well, grab that $10,000, divide it by 12, and invest, for example, $800 every single month, and that way you get the average return for that entire year and don't have to worry about like, hey, what if I invested 10K but then it dropped and now I have to wait a long time to have it recover? The answer is no. Just do dollar cost average and invest it over time. By the way, I highly recommend, okay, if you want to invest, just grab your money, right, and just take, for example, 10% and invest it every time you get paid, and that way you do it automatically, and it's also dollar cost average. You get the average and you don't take that much risk either. But guys, that's about it for this video. Comment down below and let me know if this was helpful and which investor are you, long-term or short-term. And by the way, if you want to watch a video on basically how I invest my money, I'll put a link down below. But as always, if you like this video right here, guys, well, like this video. On top of that, also subscribe and hit the bell so you're notified, and also follow me on Instagram Bryson. And before I go, if you want to watch a video basically how much money I make in dividends every single month, watch this video right here. I'll see you guys tomorrow. Thanks for watching, and as always, peace.